Hi everyone, my name is Khalil, and today I'm going to walk you through a topic that every smart investor, entrepreneur, or analyst uses daily: financial ratios. Think of it as learning the health check system of companies. So, by the end, you'll be able to look at the business and instantly understand how well it's performing. So, let's talk about why I chose this topic: financial ratios. I chose this topic because numbers alone can be confusing. So, a company can show billions in revenues, but that doesn't mean it's profitable or financially healthy. Financial ratios simplify all of that. They turn raw financial statement into a clear insight, almost like turning a huge textbook into a summary you can actually use for traders, investors, or managers. Knowing ratios means that you're not guessing, you're making decisions based on real evidence. So, what are these financial ratios? So, basically, financial ratios are simple comparison between numbers in the financial statement. They help answer questions like: is the company making enough profit? Like, can it pay short-term bills? Is it borrowing too much? Or is it using its resources efficiently? Instead of reading 100 pages of statements, ratios summarize everything into one or two numbers. So, let's talk about why ratios matter. Ratios matter for one main reason: they give context. A company doesn't exist alone, it has competitors, trends, risks, and economic pressure. Financial ratios help you compare one company against another or against its own past performance. So, you can compare a company by another, or you can compare that company from 10 years ago or 20 years ago. Investors use ratios to identify opportunities. Banks use them to decide if they should lend money. Even managers check them to improve operations. So basically, ratios are the universal language of business analysis. Basically, there are many ratios out there, but today I'm focusing on the four most important categories: liquidity, profitability, leverage, efficiency. Can the company pay its short term obligation? This is liquidity. Profitability: can it generate enough profit? And how much debt does it rely on? This is called leverage. And finally, there is efficiency. Is it using its assets or inventory effectively? Each category answers a different question about the company health. Let's talk about the first one: liquidity ratios. So, two of the most used measures are current ratio and quick ratio. The current ratio is the current asset divided by current liability, and the quick ratio is the current asset minus inventory divided by current liabilities. These ratios tell us whether the company can pay its bills or not. A higher number means that the business has enough short term resources to survive financial pressure in the future. If liquidity is too low, the company may struggle during unexpected events. So let's talk about real world example. To make this practical, here is a timeline showing how company ratios change over time. For example, in strong years, profit margin rise, current ratios improve, and debt levels go down. During tough times, like recession or pandemic, margins fall and debt rises. But in a recovery phase, we see we see improvements again. This kind of analysis help investors understand whether a company is heading in the right decision or direction, or facing risks, or becoming stronger. So, next, let's talk about leverage and efficiency. Leverage ratios show how much a company depends on debt. For example, debt to equity. You can see here we have total debt divided by total equity. This means debt to equity. And we have interest coverage equals EBIT divided by interest expensive. The higher the debt, the riskier the company becomes. And let's talk about efficiency ratios. This efficiency ratio measures how efficient or effectively the company uses its resources. You have inventory turnover and asset turnover. If a company has poor efficiency, it means money is being wasted or assets are being used fully. We're gonna talk about an example which there is a company called Apple. We all know that company. Let's talk about this company. So, if Apple earns 100 billion in net income and generates 400 billion in revenue, then its profit margin is 25%, ROA is 28.5%, and its ROE is 142%. Those numbers shows how extremely Apple profitable is, It uses its asset efficiency and provides huge return to shareholders. To wrap this up, financial ratios are one of the most powerful tools to understand a company. They reveal strength, weaknesses, risks, and trends that we would never see by reading financial statements. Whether you are trading, investing, or managing business, ratios give you the confidence to make smarter decisions. Thank you so much for listening to me, and excuse me for any English words I made mistake on. I hope you can understand this topic.